Okay, I think I'll start my presentation now. So just hold on, guys. Just share my slides. Yep. So welcome everyone. So basically, my name is Paul. I'm the assistant portfolio manager for our portfolio team. So I joined the team. Sorry, just hold on. I'll just go full screen. Try to make it full screen at the moment. Screen at the moment.
Yeah, Paul, you can proceed.
Okay, sure. Thanks. So I'm Paul. Sorry, I'm not too sure why I can't share my video, so you couldn't see my face. Maybe could you check the setting? Because it says the host has stopped the sharing of my video. Sorry, just give me a minute. Yeah, that's great. So sorry guys. Sorry for the delay. I joined the team in late last year. So been with the team for almost a year now. So I think today's presentation is basically to update everyone on our managed portfolio. So I think a lot of people do not know that we actually have our managed portfolio segment within our FSMOne. So other than unit trust, that all the thousands of unit trusts that we have on our platform, we also have managed portfolio to help clients who do not know how to choose which unit trust, because it's like there are just a lot of unit trust funds out there, and to select one and to know which countries to get exposed to, which segment, that is actually a very tedious job. So basically what we do here is that we filter the funds, and also we position for clients in terms of which sector, geographical location that we want to get into. So I'll go through that. So I think the presentation today is mainly to talk about how we managed to deliver up to double-digit returns up until July 31st. So moving on to the key reasons, right? So the first chart, I'm going to go through the fixed income segment for the global fixed income. So if you look at this chart, there are a few fixed income performance since the start of the year up until 31st July. So you have global bonds, Asian bond, Asian high yield, MY is Malaysia bond, EM is emerging market bonds. So you can see that the bond market performance, so this is all rebased to 100. So if it goes to 107, it means that it has returned 7%. But then this is for Asian high yield. Then it subsequently actually gave up the returns. So you can see this chart here. There's only one that stand out, which is quite consistent performing bond segment in the global market, which is MY bond, Malaysia bond market. So you can see, look at this yellow line, it has been steadily going up. So if you're invested in Malaysia bond, you would know that you are doing quite pretty okay as compared to many other segments within the global markets. So this is actually one of the reasons why our portfolios did well as well up until now, because we have quite sizable exposure in Malaysia bond. Because rightly so, we think that Malaysia bond market is really attractive for our local investors. Whereas you look at the global bond and other bond markets, right? Basically, it's pretty volatile, but volatile for reasons because a lot of basically the news are more centered around the Federal Reserve in terms of their interest rate hike and inflation data as well. But all in all, what we see this year is that in terms of bond performance is definitely much better than last year, because last year was interest rate hike and impacted a lot of bond markets. So this year, we do see opportunities in especially the global bond segment, which I'll go through later. Why is it attractive? So mainly in short is that basically globally, global bonds are pretty attractive in terms of their current yield at the moment. So moving on to equity segment. So equities clearly, so this is a chart on a few of the key equity markets. So the performance since start of the year up until 31st July. So you can see the one that is doing pretty well up until July is basically the top few lines here, the blue ones, the dark blue and the light blue line. So the dark blue line is basically your S&P 500 US, and also the light blue line, that is MSCI World Index, which has a lot of the developed market exposure. So basically, if your portfolio is much very heavy weighted in the developed market, especially US, and also basically the technology segment as well, then you will do well this year. And if your portfolio is much into those bottom one, which is your Hang Seng and also CSI 300, which is your China index, then your performance this year would not be as good. So rightly so, we are actually very heavy in our portfolios, very heavy in the developed market. So especially we have heavy exposure in US, Europe, and also quite sizable exposure, decent exposure in the technology segment as well. So that's why that actually contributed to our year-to-date performance. And moving on straight into the performance data, right? So this is our historical performance for our conventional portfolios. So I will talk about our Islamic portfolio as well, because we have both conventional and Islamic. So I think both also play a very important role in clients' portfolios. So I'll just go through this one first. So this is our performance since inception. So inception date was the year was back in 2017 May. So all the way up until performance up until now, this is the same inception numbers. So if you look at the individual years since 2017, 2018, 2019, 2020, 2021, 2022, and year to date July, you can see that our down years basically is in 2018 and 2022. So more or less, we actually have more up years than down years. So of course, in 2022 is pretty much unavoidable in terms of the down markets, because basically last year every market went down. Most of the markets went down last year. So basically most portfolios would be affected. And but this year we managed to ride the recovery. So you can look at our aggressive portfolio. A is aggressive portfolio. MA is moderately aggressive. B is our balanced portfolio. MC is our moderately conservative portfolio. C is our conservative portfolio. So even our most conservative portfolio is returning about 5.2% year to date. So I think this year performance is pretty decent. And there's one thing that I would like to share with clients as well, is that we do not raise cash. We stay invested all the time. So when most of the markets are down, our portfolios would be impacted as well, because we don't raise cash. but we do try to manage the exposure to limit the downside. So basically, if you compare our performance to all the major markets last year, right? Actually, our performance has been much better position rather than all the key markets, which went down much more. So one thing is that our portfolio is mainly to help clients to stay invested and also manage the risk. It's not a portfolio that it's not a get rich quick kind of scheme. It's more a portfolio that allows investors to stay invested while not too worried about the risk about managing the exposure within the portfolios, because that is that is something that we will do for our clients. And moving on into Islamic portfolios. So Islamic portfolios also did pretty well this year to date. So our conservative portfolio returned 5.5%, our aggressive portfolio returned 12.1%. So we launched our Islamic portfolio back in 2019. So since 2019, we only had one down year, which is last year, which, like I mentioned, most of the markets were down. So it's pretty much unavoidable. But there's one thing special about our Islamic portfolio is that if you do have some money that is very conservatively managed, actually can consider our conservative portfolio, our Islamic conservative portfolio, because since inception, it actually returned about 19.9%, and this year 5.5%, which is, if I do the math, is actually much better than putting money in FD. That is how I see it, our conservative portfolio, which invests about 90% in fixed income. Yeah. So I'll go through in terms of the details where we allocate the money, but these two slides is just to show the track record of our managed portfolios. So I think some clients might compare our portfolios to some other best performing fund on our platform or whatever, so comparison. But all in all is that our portfolios are not here to generate superior return. It's just some decent returns for investors who want to manage risk and don't know how to might not know how to navigate the investment world. So moving on to where we are now. So in terms of our allocation and exposure, so in terms of inter-asset allocation, which is the difference between equities and bonds, we are currently overweighting the equity segment by 5%. So basically, our mandate allows us to underweight by 15%. So this overweight of 5% since the start of the year have actually benefited our portfolio as well. So we currently still maintain this overweight 5% because we still think the equity market pretty there's still a lot of opportunities, and we still like the outlook for the equity segment. So and rightly so that it has benefited our portfolios. So I'm not saying that we are negative on the bonds. Actually, we like the bond segment a lot too. So I'll talk about it later. Because you can't not like the bond segment because it's giving you pretty attractive yield at the moment. If you look at individual bond papers on our bond supermarket or even bond funds, actually generating quite good returns. So moving on to our conventional portfolio. So sorry, there's some Q&A. I'll go through the Q&A later. And I'll go through the Q&A later. I'll go through my slides first. So basically on the, so this is our conventional portfolios exposure for our bond segment. So you can see that we're actually quite heavy in Malaysia bonds. So this is Malaysia short duration bond, about 20% allocation. This is Malaysia long duration bond, 35%. So why we have more in long duration bond means that we are taking we're actually investing into bond papers or bond funds that have longer duration. So imagine your FD rate, the longer it is, it gives you higher FD rates, right? So it's the same thing for bond funds. So we are investing in something that's longer duration. which give us a higher yield because we do really like the current yield. So I'll show you the chart later. And also on the global bond, EM bond, Asian bond, the yield are actually very attractive too. So you can see that early on I show you that the bond performance, global bond, EM bond, Asian bonds, right? Actually, it has been moving sideways. So instead of significantly impacted last year. So that's on bond. And this on equity portion for our conventional portfolio. So if you look at equity portion, I think everybody would be very well aware of China market. So if you look at China exposure for our portfolios, actually now is down to 3.5% of our exposure going forward. So it's a very minimal exposure. So having very minimal China exposure also help us to mitigate a lot of negative impact from China this year. So if you look at other segment of our portfolio, we have quite a lot in US, Europe, and then also if you look at the top part here, technology segment. So basically these few areas and also our Japan exposure have actually done very well and help our portfolios a lot. And also Malaysia exposure also did help our portfolio because Malaysia, if you notice on our platform, there are certain Malaysian funds that have done really well. So we actually have exposure. We actually have our Malaysia exposure actually through some of the very good performing funds, Malaysian funds. So also we have Asia, Japan, and emerging markets, which is relatively smaller exposure, which have done. I think these segments have returned probably 1 to 5% this year, but bulk of the return year to date actually from the developed market. So these are actually the key reasons why how the performance were generated for up until July this year. So going forward, it would be this positioning. So we will change the positioning when we see fit, when there's a change of view, or when we think market condition might not be suitable for a certain allocation, then we will do the changes. So, but at the moment, this is the changes. If you invest today or tomorrow, this would be the allocation. So in terms of the individual funds, within this segment, actually can go through our fact sheet. Our fact sheet will show you the very detailed fund allocation. But for today's presentation, I would like to keep it simple so that everybody understand where are you exposed to in terms of your portfolio. So that is conventional portfolios. Then moving to the Islamic portfolio. So Islamic bond exposure. So early on I mentioned that do take a look into our Islamic conservative portfolio because it has done really, really well in terms of the being very conservative and return compared to our FD for the past 4 or 5 years. Actually, is pretty attractive. And the reason is because our Islamic bond portfolio is mainly invested in Malaysia bond, 100%. So like I mentioned, Malaysia bond segment actually has been pretty resilient and very defensive and pretty attractive in terms of for local investors. So there's something for everyone to consider. And moving on to our Islamic equity exposure. So our China exposure, if you look at here, 3.5% is also pretty minimal. So it's the same thing that having minimal exposure in China actually help our portfolios a lot for Islamic as well. So our global equities exposure about 42%, Asia, Japan about 33%, Malaysia about 10%. So the bulk of the performance is similarly mainly driven by our global equities, Malaysia, and our technology exposure. Yeah. So those are the what I've gone through for the past 10 to 15 minutes is on our what actually contributed to our returns and also our current positioning. So I will touch a bit on why we should be positive on the market, and maybe for some investors, I will also go through what happened last year, right? Because last year has been pretty challenging, but this year is basically a different story altogether. So I will touch on two key markets due to time constraint. So I'll definitely touch on US market. So US market here is that, so what happened last year was the interest rate increase. So rise in interest rate, of course, it impacts a lot of things in terms of businesses, consumers, and of course, when consumers and businesses got affected, then your stock market will get impacted as well. So we can see that US raised interest rate from near zero to about 4% to 5% end of last year. So part of the interest rate hike actually was last year here, from the start of last year up until end of last year. But since beginning of this year until now, the Federal Reserve, the Central Bank of US, actually have been hiking rate as well, but on a lesser extent. So because they have done part of it last year already. So that is one of the key reasons why you see that why the markets, the developed markets, has been rallying as well. Because if the central bank has mostly done with their rate hike, then we actually end of the very challenging period. So the challenging period was last year. So it's very so another thing that I share with investors is that it's very important that we don't live in 2022, because 2022 was last year. So it's important that we live in 2023, which is this year, and things are different. So every year not the same. So that's what you can see in the market as well. And then so another thing, why would we think that the interest rate hike might be coming to an end or should be slower, is because the reason for central bank to raise interest rate is because of inflation. That's the main reason. And inflation, rightly so, it has been rising since 2021. If you look at here, early 2021, it has been rising to a very significant extent to the peak here. So this is the US CPI and US PCE. So US PCE and PCI is two inflation data. So so if you look at both data, it actually peaked in actually mid last year. So since mid last year, it has been coming down, right? So I think there are a lot of debate in terms of whether inflation is still is going up or inflation coming down. So I think if you look at the fact, right, data is data. You can't really challenge data. So data is really showing that inflation, you look at the CPI data, actually been coming down. So there's no way that for anyone to argue inflation is going up. So if there's no way for anyone to argue inflation is going up, then the Fed or the central bank of US should actually stop raising rate, because rates because they have managed to calm or lower inflation, which is the line that this chart that you're seeing. And so even the rent index in US, so you heard about a lot of comments on, oh, the housing market is still very strong, or the wages still very strong. But if you look at this data, the rent index and the blue line, and the wages, the hourly earnings, US hourly earnings, the orange line, actually also been coming down. So there is no way for anyone to challenge that inflation is going up, because all this line is coming down. So if that is the case, then this year should be a very good year, which it has been a very good year up until July, even now, actually. So unless this changes, then we will need to change our positioning. But so far, things are looking quite good for this year. So why am I talking about inflation, right? Actually, there are a lot of news, there are a lot of negative news, or a lot of developments in the market, this and that. But I'm only focusing on inflation because it is actually the key, most important thing happening in the market since recently. And also moving forward, if you look at this next slide here, this is US as well. So the orange line here is the S&P 500 index performance. This is since beginning of last year up until August last month. So you can see that the S&P 500 index actually bottomed about mid of last year, since mid of last year, and it has been going up. And you can see that there are another line that is coming down, contrasting to this upward line is CPI numbers, the inflation number, which has been coming down. So if when inflation goes up, yes, it makes sense that for the market to go down. And when inflation start coming down, the market can breathe. Basically, the market can breathe better, because knowing that the key risk is actually getting softer. So if you talk about inflation risk, right, we definitely would need to look back at the 1970s inflationary period. So in 1970s, what happened was that the inflation was pretty high, and it was one of the key issues in the history of inflation or central bank. So if you look at the price performance of S&P 500 back then, this is S&P 500 bottom in somewhere in late in 1969 here. So it actually marked the peak of the inflation number. So when inflation start coming down, you can see market keeps going up. So this is the key reason why I'm showing this inflation number. So if I were to share where we are now, most likely we are actually somewhere here. We actually haven't gone to the peak of the where all-time high last before the correction or pullback last year. So now we are actually going through this recovery similarly to this period back in 1970s, right? So so another chart here is to show that a lot of people might be asking that, oh, US has rallied so much, isn't it risky or whatever it is? But to be honest, US is just recovering from whatever that was lost last year. So then if you dig deeper into the S&P 500 index, I think everybody would know that the top 5 and 7 stocks in US actually drove most of the returns for S&P 500 index. So S&P 500 index, basically the index is calculated based on market cap. So the bigger you are as a company, you have more weight represented in the index. So if you do an equal weight index, then the price performance actually show different kind of trajectory. It actually the price return actually did not rally as much as the original 500 index. So this is the equal weighted index, which means that there's actually a lot of opportunities still in US, especially those companies that is out of these top 5 or top 7 companies. Yeah. So this is the price performance, and on your right is the valuation chart. So you might know that there's a difference between price and valuation, right? So valuation, we are looking at price to equity, price to earnings here. So if you look at price to earnings ratio here, what is considered expensive and what is considered cheap is basically is your PE ratio. The lower it is, the cheaper it is. So if you compare now to historical valuation, we are actually at the levels that is not considered expensive. If you look at especially the orange line here. So back in the end of 2020, that was expensive. So no wonder market actually took profit, and the market did it pull back and correction, because it was actually at pretty not that cheap territory. So today I'm showing you this chart is to show you that we are not in 2021 or 2020, end of 2020, we are actually in 2023. So one point is that, so investors have been asking since end of last year, investors have been asking about their portfolios. Then my answer is that actually is very attractive. We have been in a very attractive market to do RSP and actually keep investing when prices are low or keep coming down, right? So that is actually the way to also have to enhance our long-term returns, especially for our clients as well. So so it's very important that not to get too scared when market offers good opportunities. Yeah. So that is on US. The next is I will talk about China. So China, very quickly, I think in short is that you look at our location, which is very minimal in China, is that we actually we at this moment we have been negative on China since the start of this year. So that's one key point. And the next point is that why, right? China has been coming down, but why is it still so bad? So the thing is that you look at this chart, this the green line here is the earnings of the companies within this index. This is the China index. So all the companies combine their profit expectation and also the actual numbers that that analysts project. So then the white line here is the price performance of the index. So this is the October low. So everybody knows that in November, the Chinese government start announcing the reopening of China. So then all the analysts in the world that covers China got very excited. So they revised the earnings projection forecast for the Chinese companies. So this green line. So, but then after reopening, then only a lot of people found out that the projection was actually analysts were too optimistic on the projection, overestimated the reopening of China. So then they started trimming the earnings. So this is the price are moving towards moving similarly with the earnings of the Chinese companies. So there's nothing that don't make sense. So there's a reason why China is moving that way. Why China is moving, why China is underperforming this year. So then this is one. The other thing is that there are a lot of challenges facing China. So of course there are a lot of political kind of geopolitical issues, and also the political dynamic within China. So those are the more macro factor. But if you drill down to the sectorial factor, then you have the property market in China that got impacted very badly. So I'm just trying to give an example here is that how do people make money, right? So there are a few ways. Basically your job. Secondly is your investment, if you know how to invest in the stock market or companies. And the third thing is basically making money from houses. So this is more so in China, because in the past, China, what happened in China is that property, when you invest in property, you are kind of guaranteed that you will make money 5 to 10% per annum. So it's no brainer that people would save their money in properties, but it's no longer the case anymore in China after the Chinese government some sort clamping down on the property market. So they want the property markets to be for stay rather for investment, and so there are also a lot of things going on in the property market. So but in short is that there's actually one less avenue for investors or household to save their money and make money, which is the housing market. So imagine you are there, and this actually can be a very huge uncertainty, and it will impact how you do your financial planning. You'll be more scared because of all these issues that's going on, change in policies. You're uncertain about the future. So then you look at the chart on the right, which is the China Consumer Confidence Index. So the drop here is since the drop in this Consumer Confidence Index back in early 2022, actually it has not rise up back to these levels. And even the recent reopening here in January, China, actually it also did not push the confidence index back to these levels. And actually recently in April, it actually dropped back to a low level. So what it says is that actually you if you do go to China and or you have friends there, you will know that on the ground uh, people are actually quite uncertain in terms of how they should uh, how they should like for businesses, they are not sure whether they should expand or not because of all these policy uncertainties. And even for consumer, even unemployment, it's true that the youth unemployment is very high in China. And that's because for the past few years, China has clamped down a lot of big sectors like the technology sectors, the education sectors, which employ a lot of youth. And imagine the technology sectors, which, for a tech sector that going through a government clampdown, you basically stop expanding and reduce hiring, those kind of things. So that actually would impact a lot of, that would have a lot of consequences, which China is facing now. So a lot of things that we need to watch. It's not that China is uninvestable, but at this moment, because things could change, right? So at this moment, these are all the facts that is facing China. So when only if when we see things turns um, differently, then we might actually change our location. So not until then, if it continues to stay like this, then pretty much our positioning would still be very minimal in China. A lot of bad news for China, but the good news is, of course, why fund managers are still very actively monitoring China like ourselves is because we have very low exposure, but then China is also pretty attractive in terms of their valuation. So if you look at this price to earnings chart, so of course back in 2021 it was the peak here, so that was very expensive, but now it's actually pretty attractive. Now is basically is more towards how the uh, how the macro dynamic would change that make us change our view on China or turn more positively, because Chinese equities are really attractive. So, but attractive alone is not enough. We need to see much more factors for us to change our view to change our view on China. Yeah. And the chart on the right is to show that Chinese household actually still got Chinese households, they are very rich. So like if you look at last year, right, the amount of money they saved actually was 17 trillion renminbi. This is a lot of money, 17 trillion. So this is just the incremental saving for last year. I'm not talking about the existing money they already have. This is actually on top of it. So like for this year, 2023, the amount of savings households are saving in China actually continue to rise, the gap here. So these Chinese, they are really, really rich. They are not poor. The only thing is that because sentiments is so bad, everybody got very, very scared. So when people get scared, what they do is that they try to be defensive. They try to save more. You need to have some money during rainy days. And then what happened in China is that during COVID time, uh, because of the suffering they went through during COVID, China had a very long lockdown. So it was very tough environment. So rightly so, after that, you can see there's more defensive kind of behavior coming from China citizens. So basically what we need now is to monitor some of the factors in China to for us to get more positive on China. Yeah. So that's on China. So I think in summary is that basically globally, I think we are kind of at the end of this rate hike cycle. So which has been very positive for the global, especially the developed market. And China, as you know, as I just shared, there are factors that we need to monitor before we even if you want to consider turning positive on China. So which is not now yet. And that's on equities. And on fixed income, so if you look at this chart, earlier on I mentioned that we are actually very positive on the fixed income segment as well. And that's because if you look at the left chart here, this is the Bloomberg Global Aggregate IG investment grade yield. So what this means is that this chart actually represents all the very high quality investment grade companies and what they are paying on the money that they borrow, right? So you can see that the yield is actually back. So this is the yield. Think of it as in the interest rate the banks are paying you on your FD. So you can see that, of course, during COVID time, it was very low. It wasn't very attractive. But then now it has gone up to an area which is back to 0809 crisis, the global financial crisis. So if nobody, it depends on whether you agree that we are not in a crisis that is back in 0809. So personally, I do not think that we are at the moment anywhere close to 0809 crisis. But if you look at the investment grade yield, actually back to that area, which I think is a very attractive dynamic for investors to be invested in the global bond. So that's on the left. But I think something that everybody would be much more, would understand much better is the Malaysian scene. So if you look at Malaysia, our MGS yield actually also back to pre-COVID levels, back to pretty attractive levels, which if you look at the individual bond papers or bond funds actually giving about close to 5% or some even up to 6% for pretty good corporates. So why would bond fund or bond papers be very attractive, right? It's because if you do a comparison, so of course it's back to pre-COVID, which is very attractive. The other reason is that if you compare to your FD rate, yes, it has been rising, but your FD is only locking you in for 12 months or maximum probably 18 months. But bond papers can help you to lock in terms of this high rate for 3 years, 5 years, or some even 7 years. So basically that's what I was saying, that we actually going much long duration. So we are trying to lock in terms of the good rates on a longer period. So that's the explanation on the yield side. So similarly, like Bank Negara, this OPR rate, the blue line, the bulk of the increase in OPR actually was done last year. Even this year, there was actually minimal hike, and the last round was actually there's no hike in terms of OPR rate. So our Malaysia CPI inflation data, inflation number actually pretty manageable as well. So all in all, we are very positive as well on fixed income. But of course, portfolio-wise, we do see better opportunities in terms of the equity side. Then I think I'll just quickly go through a few. So one thing about managed portfolio is that we do write money commentary. So you can go through, you can look for our investment specialists to understand where we post all these articles. So if you have time, you can go through money commentary. So if you do not have too much of a time, you can actually go through our quarterly commentary as well. So all these articles are we post it on our platform. So you can see that since so this one since February, early this year, actually since last year, we've been posting articles. So you can see that even so, we make it very user friendly in a sense that if you have really no time to read, you can actually look at the pictures. So it's a rocket shooting up that for the February early this year and May this year articles. And the recent one, August, I was using a different picture. So if you click on it, it would give you a very it will give you a summary of what we think happened for the past for the specific quarter, and also what we think going forward. So it will give you a sense of whether you want to be more aggressive. So you remember we have aggressive portfolio, moderately aggressive, balanced, moderately conservative, and conservative portfolio. So basically it will give you a sense of whether you want to stay conservative, aggressive based on your current risk appetite, right? So one way is that how do you know how do you know when do you want to be more into equities and fixed income? So you need to go through you need to really get an idea about how you should be positioned. Should you be aggressive, conservative? One way is to go through our articles. Our articles can give you a sense of uh, uh, what we think about the equity market and fixed income market. So if you go through our fixed quarterly articles, you will notice that we have been consistently mentioned that we are overweight equities. We are quite bullish on equity segment. So which has been pretty right position for this year up until now. And if you really do not have time, then you can actually come to our FSMOne events. So basically we have about two very big events. One is the What and Where to Invest. It was early this year, January, and there was another one which is our recommended fund event, which was in July. So we have these physical events that you can actually engage our team, and we can talk about what we think about the market, and whether whether which portfolios are actually more suitable for clients based on the risk appetite at the moment. Yeah. And I think that's it for today. I think basically I probably want to sum up with just one last slide. Is that if for long-term investors, right? So when do you want to stay? How do you look at the market, right? Because it will be very challenging for investors to understand or track the market, and it's because there are a lot of noise in the market. And if I would actually can do, to be honest, I can actually do a different presentation that talk about all the negative things in the world, because every day, every month, every week, there will be a lot of negative things. But we, as investors, we do need to cut off the noise and look at what is really happening, how the world move. So basically how the world move is that if you look at this performance, right, this is the past 100 years performance every year for Dow Jones Industrial Average Index. So this is basically the second oldest index in the world. So it does give you a good sense of actually we have more up years than down years. The up years means the green bar. The red one are the down years. So we have more up years than down years. And secondly is that every time after the very significant down years, you actually can see quite positive direction for the market moving forward. So then also very important to understand that the world actually have gone through a lot more serious issue, like the Great Depression in 1929, the OPEC oil price shock in 1973, dot-com bubble, global financial crisis in 2008. So whatever that we are going through now is actually is an inflation issues that I have shown early on that have actually been softening in terms of the inflation number. We had the peak inflation last year. So so I think a lot of people might be questioning, oh, the market is crazy. Why is it keep going up? Actually, the market is not crazy. There's a reason why the market is moving that way. It's just whether investors can catch the point and ignore the noise. So ability to ignore noise is very important. So I think one example that I would like to guide investors is that if you look at if you look at the world GDP, the world GDP numbers, this is basically the combined revenue of all of the countries in the world. So you can see the long-term trend, right, actually been going up. So which means that most countries, the world as a whole in aggregate, actually been very productive, been generating more revenue, been developing and growing. So, which is similarly to the price performance of this world GDP weighted index, which on long term it has been an uptrend. So, obviously there's volatility along the way, but on a longer term, it would actually follow fundamentals. As long as humanity still progress, we still being very productive, innovative, and still grow, then that would be something very positive for the whole world and the development of the world and also of the market as well. So of course, throughout this journey, there will be a lot of noise. So we need to know how to filter the noise. Okay, I think that's all from me from my presentation. I'll just take questions. I'll take the first questions. When sell amount from managed portfolio, how is the fund to be so selected? As some would be in profit while others might not be. Actually, this is so the thing about us is that we are not too sentimental about not too sentimental about profit or loss, because at times when there's a need to cut loss, we will need to cut loss. That is actually one of the key to investing, is to we need to reposition based on new information. If new information suggests us to cut loss or even to take profit, we will do based on the information. Yep. Then actually, just to share that, actually, I do know a lot of investors been keeping their stocks for past 10 years or 20 years, and it's actually some sunset industry. So that's very damaging to one's portfolio. I think it's not too good to be too sentimental. It's like own it as a baby. Actually, investment is just a way to participate in the market. It's not like a baby or something like that you need to hold on to until some investors even hold stocks that been going down and until it goes bankrupt. So investing shouldn't be like that. We need to reevaluate almost every day in terms of every information, whether we need to change our positioning. Then second question is, how do you define the return of 5.2% to 12.9%? I've subscribed aggressive portfolio since 2021 and do regular top up almost every month. However, the return till now still showing negative figure. So basically the 5.2% is our conservative portfolio. So this is year to date. So so this is the calculation based on the start of the year up until 31st July. So we don't, there's nothing about RSP during this period or whatsoever. So, and the 12.9% is our 12.7%. 12.7% is our aggressive portfolio. So it's the same thing. It's the start of the year until 31st July. There's no RSP or top up or whatever. It's assuming that the portfolio invested at the start of the year. And I think the reason why it's negative, the portfolio is still negative, is because most likely is because since 2021 it was at the peak of the market. So that's why it got impacted. I think for more detailed explanation, you can actually engage our investment specialist. And moving on, FSMOne published an article, "Is China's market finally too cheap to be ignored?" in 18 August, which mentioned Chinese equity may be a value tag. Why is managed portfolio still invest in China and Hong Kong fund. Actually, we are actually been our mandate actually allows us. Actually, we have our mandate do have a specific location for China, but we actually underweight the China exposure. So so why are we still investing is that one thing is that China is still a very big economy. It's the second largest economy, and also I've shown that the valuation is very cheap, and China, they are still the households are still very rich. So at any point in time when those factors that I was talking about, if it does come out, then it will be very positive for China. So we try to be very nimble in terms of how we want to position, how we manage our portfolios. So it's not that we are negative on one area, then we are completely out. That's not the case, because China is still the second largest economy in the world. Yeah. So next question is, how divergent or similar are your investment strategy and policies compared to those of FSMOne Singapore? I think we do have, there would be general framework that is pretty similar. Of course, in terms of actual implementation, we do have the local team in Malaysia do have some leeway in terms of how we want to. It actually depends on how we argue for our position, how we are trying to position for local investors as well, because Singapore market and Malaysia market is a bit different. Singapore, for one example, Singapore bond market is not as resilient as Malaysia bond market. You look at Malaysia bond market is fantastic. Basically is a very pretty attractive market, like very special bond market, I would say, for Malaysia. And that's one example. And I think the other example is mainly on the fund selection as well. There are certain funds that are not available on our platform that are available in Singapore. So that could make some differences. So those are the two key important points. So next question is on what indicators would make you turn bullish on China? A lot of things need to change. Basically, the big things, the politics, basically whatever that is driving China down for the past 2-3 years. So you can see in terms of the political situation, geopolitics, you do need to see a lot of improvement or changes there, and how the country manage the local landscape in terms of the corporates and businesses. Just imagine that you are someone, you are an entrepreneur in China, or you're a businessman in China, you're a citizen in China. How do you feel with all these policies, the life that you will be living with those policies, right? So it's actually pretty uncertain in terms of, basically it's all more on the policy side. So, basically, you will definitely know when it comes in terms of when to turn positive on China, because I think most investors might not feel it in their bones in terms of how serious the policies are in China. How is it impacting the entrepreneurs and also the businesses? So, I think I'll leave it there. I think if for more detailed explanation, I think you can either call us or take this question offline. Yeah. And the other, next question is on, if you say buy low attractive, China low now, why not RSP now? I wouldn't be commenting on individual country. I think I will just comment on our managed portfolios, and that's because for me to say buy now, I would need to share when to sell. So it's a bit irresponsible for me to say ask you to buy China now, because then the other point is that for the past 3 years, China has been going low and low and lower and lower. So low is not just a key factor. So I did say China is pretty attractive in terms of valuation, but I think I did emphasize that valuation attractive is just one factor. There are a lot of other factors that need to be considered in terms of whether you want to put more money into an area or segment. And that's because cheap doesn't mean it's good. But cheap can be good too, but depends on the situation. Yeah, which is a situation that we are monitoring very closely, so that hopefully that if China does rebound, then hopefully we can have much more exposure, then hopefully we can catch some of the performance. Yeah. So I think the next question is, global recession still on the horizon given the inverted yield curve? So basically, global recession, the question is very funny, right? Because if you read news or the analysts out there or whoever that give commentary about recession, so once in a while you do get recession, because that is part of the economy, right? And the challenge is to know when recession is coming and how you position for it. That is actually a much more relevant question. And I guess I guess most people got the recession angle wrong, because inverted yield curve, the inverted yield curve has started since I think since around early last year. So it has been more than a year already. We are not getting a recession. But actually some people do think that actually recession has already happened, which is end of last year. But whatever it is, recession or not, I think our portfolio positioning is much more important, because if we think recession is bad, then we don't invest, then we actually would miss out a lot of gains this year. So so the other question is that how will recession impact the market, and how should we position during recession? Is recession going to be very bad or very mild? It's actually everything is just a guesstimate at the moment. So I think in short is that what I would share is the more official argument, which is from the Federal Reserve Central Bank of US, is that recently in their their minutes, the meeting minutes they have, they actually have dropped the expectation of a recession, because the economy has been pretty strong, and the labor market also pretty resilient. So at this moment, the official view from the US Central Bank is there won't be a recession. Yeah, but things could change. Depends on new information coming. What information we get. So so I think in short is that I will not rule out there's no recession, but it's something that we monitor. So that's the reason why we have a portfolio that we closely monitor for clients. Yeah. So next question is, how do you define how I think that was next. How often do you rebalance the portfolio, on regular basis or based on new market development? This is a very good question. One thing is that we entered the year very well positioned, and for the first 6 months of the year, we actually did not make any changes to the portfolio. And that's because, like I said, very well positioned. But recently, for the past since June, July, August, we have done rebalancing. We have done changes. we have made quite a bit of changes. So you might have noticed your portfolios have different fund name or different exposure, different weighting as well. So we do rebalancing when we think it's required. So it's not something like we want to fix it every month we do it. It's not the case. We only change it when there's a new development. Basically is not to say new development. New development is one thing. The other thing is that what we think going forward that clients can benefit much more from our portfolio positioning, then we will do the repositioning. Yeah. So I think that's it. I've answered all the questions. Any more questions? I think if there's no more questions, I will end the session. Thanks, everyone. You have any more questions that I've not answered that you weren't able to ask, you can actually always engage us. You can give a call to our investment specialist, or you can come to our events, physical events, which is pretty exciting, interesting events as well. So thanks, everyone. Thanks for your time.